Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. With me today, Dr Samiran Chakraborty, the Managing Director and Chief Economist, India at Citibank. Welcome, Samiran. We are scheduled to have a conversation on the Monetary Policy Committee, but we are having this conversation at a time when the political stock exchange had a big impact on the Bombay Stock Exchange, on the National Stock Exchange. But I don't want to ask you a market question. From a broader macro standpoint, the fact that Modi 3.0 is back, and we will see the contours of the formulation later on during this week. But what are the key challenges and opportunities that the incoming administration has in front of itself?
Thanks, Siddharth, for having me. So first, the current macro backdrop is quite good, quite favorable for us. We have just got the FY24 GDP growth printing above 8%. Most of the macro stability parameters, whether it's inflation, current account, fiscal, currency, everything has been very orderly. So that way, the government does not have an immediate macro challenge to deal with. In fact, I would argue that two sets of macro policies that the earlier government was following, one on the supply side economics of boosting infrastructure, manufacturing, technology, digital, and the other is on preserving macro stability. Both these things should be continued exactly as it was. Now the question is, what can you add on to this mix? And there could be two different things that can be added on. One is that if there is an assessment that the economy can or needs a little bit of demand stimulus, then how you design that demand stimulus through some sort of redistributed policies. And the second aspect is that if we think that this 7%, 8% GDP growth is not good enough for us and we have to get to even higher growth path, then what sort of productivity boosting reforms or actions that needs to be taken. And that could be to boost productivity of capital, where all these structural reforms will come at play, or it could be to boost productivity of labor, where all sorts of job creation type of discussions can take place. So these are the two areas where I think the government will have to think afresh that whether we have to sort of bifurcate and go into these two directions as well, while preserving the supply side as well as macro stability.
It's interesting that you mentioned this because viewers, if you look at the election data, it's clear that the BJP lost as many as 60 seats in rural India. And some of the rural distress that we have been talking about for quite some time now could have well fed into this electoral reversal. Samiran, given that, and you mentioned supply side, do you think it's time to sort of switch gears a bit, and especially with the budget that is likely to provide an opportunity, and that budget part of a 100-day roadmap which perhaps is now going to be tweaked, but broadly one of the key pivotal moments where the government can signal that it is serious on a consumption revival, especially in rural India?
I don't think we need a complete overhaul of things here. Only a tweak or a nudge might be good enough on the demand side. Because if it was a generalized demand problem across the economy, the results would have been probably very different. It's probably in certain pockets where this constraint is more than others, so we can address this in a more targeted way. Having said that, this is also a year where we have a little bit of fiscal space available. The RBI dividend has been much better, so our sense is about 0.4% of GDP. Fiscal space is definitely there, even if the government wants to meet that 5.1% of GDP fiscal deficit target. So the government can, in a judicious way, utilize that space and provide some succor on the demand side without completely overhauling from the supply side entirely into demand.
Can we expect the government to shoot for a sub 5% fiscal deficit number?
I think that's the only area where the election results might have had a change of view from the market. The fixed income markets were clearly expecting a sub 5% number before the election results. Now people are turning probably a bit more realistic and saying that if the government has to do a bit of demand side now, maybe sticking to the 5.1 is good enough and they will not aim for anything lower, but we'll all have to wait for the actual budget outcome.
Fair point, and I think the markets will definitely take that in line uh, if that scenario were to pan out. Samiran, how has this very, very hot summer been for inflation? I don't want to ask you about the impact on the elections because that's not our subject, but how has it been on inflation? And that kind of leads me into the next question. What is the inflationary backdrop and the readings that the MPC might be taking up when they meet?
So we were a bit lucky that the heat wave came after almost the entire winter cropping was done. So that way the winter crop was saved, so to say. But having said that, there could still be some impact on the vegetables, particularly the quality of the vegetables. You know that vegetables have to be preserved for a 3 to 6 month period, whether that quality is good enough to be preserved for that long. So there could be a bit of impact on inflation coming at the back end. But what we have already observed is a very unique impact on things like egg prices, chicken prices, some protein items where we've seen significant month-over-month jump between April and May. So that's something which has pushed up our inflation forecast for May to now again above 5%. We're thinking that next week when the data comes out, it will be more like a 5.2% inflation print. So a little bit of a shock is coming from the very hot summer, but we don't know whether this is going to be lasting over the next 6 months or so.
Will a monsoon help cool it off, or will it kind of add to it, given what happens with when there's a heavy monsoon, and that also impacts food inflation, therefore?
So at this point of time, we only have a forecast of a normal monsoon, but over the years, we have observed that not just the quantum of total rainfall, but also the spatial and temporal distribution of that rainfall, which matters quite a lot. So to be honest, we are all sort of guessing out here that how this is going to play out. But yes, although our dependence on rainfall has come off with better irrigation facilities, etc., we can't say that our inflation is foolproof from monsoon-related trouble.
So given that, by when do you expect 4%, or is that off the table for the immediate short term?
So we are going to be very lucky very soon because of favorable base effects. I think in a couple of months' time, you will find that inflation numbers are dipping closer to 3% or maybe even below. But that's not going to sustain for very long. Our sense is that we'll probably be again inching up above 4% in the latter part of the year. But for the full year, full fiscal year, we are looking at around a 4.5% average inflation. 2-3 things we need to keep an eye on. One is that global metal prices have increased quite substantially. So is there going to be a feed through of that onto Indian inflation? The second is that there's some talk of telecom price revision. That could also have an impact on core inflation. And third is what we were discussing, the weather-related, both the hot summer as well as the uncertainty over monsoon, how that impacts the food price.
Okay, so if that is the kind of inflation outlook, and I'm sure the RBI, which has all these inputs plus some of its own that it works on, how do you think the wise men of the MPC are going to vote at the meeting?
So at this juncture, our sense is that it's going to be a status quo policy with both the stance as well as the rates remaining unchanged. We think that this little bit of volatility that we saw, this is not the right time for MPC to rock the boat further with more changes. So they will also wait for how the fiscal outcome comes next month in the budget. And then probably by August, we will also have some idea of how the monsoon has played out. So maybe try to tinker with the stance in the August policy. And then probably October is when we can expect the first rate cut. We'll have a good quarter of low inflation numbers. We'll have clarity on monsoon, and we'll have also clarity on where the Fed is going with their own rates. So maybe that gives the first opportunity for RBI to cut.
Okay, Samiran, I lost you for a bit. Did you say October for a cut? Did I hear you right?
Yes. That's what we are looking for as the first cut.
So therefore, for all the analysts who listen into the RBI governor and the commentary come MPC day, will the most important thing be to read for signals for the start of the rate cut cycle?
That's quite clear because RBI has managed liquidity very well over the last few months, and that's why all the concern on the liquidity front is now much lower. So any sign of RBI signaling the rate cut would be very closely watched.
Samiran, we spoke about some of these key events, the budget, the bond index inclusion as an addition, the monsoon, and what the US Fed does and other central banks. In balance, if the RBI and MPC, if the consensus is that it is wait and watch, but within that wait and watch, which of these events is the most important, or is it a combination of all?
Yeah, ultimately, RBI will be covered by its own inflation forecast. That's going to be the most important thing. If in RBI's 9 to 12 month ahead inflation forecast, the headline CPI is aligning to 4%, then they will be in a position to start easing rates. But if for some reason that is not the case, then I guess the rate cuts could be further delayed.
Where does the global rate cut cycle stand presently, Samiran?
So it's more desynchronized now compared to what it was in the last few years. You would recall during COVID, all central banks cut rates. Then we had the war period when everyone hiked rates. Now it's a bit of mixed. Some developed central bankers have started cutting rates while others are on wait. Everybody is looking at when the first Fed rate cut happens. But even within Fed and ECB, the timing is not going to be perfectly matched. So that desynchronizing is affecting emerging markets as well. Some emerging central banks have actually hiked rates also very recently, like Indonesia and all, rather than cutting rates. So that way, RBI does not have to follow a particular template which is available globally. There are different people working differently. RBI will have to choose its own path depending upon how the domestic growth and inflation outlook pans out.
A good point there, because that is what I thought of asking you as you were answering this, because if expectations are of a ECB cut this month and the Bank of Japan and of course the US Fed, this is an important point that you make, that the RBI perhaps doesn't have to be in sync with what other central banks do. So if therefore, and it's very clear that you say that 6.5% will stay at least till October, I want you to talk about how midterm growth prospects are looking, especially from the point of view of perhaps some fresh priorities, renewed priorities that the new government may choose to add on, although the impact will not be felt immediately. But answer that question about how medium-term growth prospects look like to you.
So out of the different drivers of India's growth, I think the investment side is doing quite well. I would argue that not just public investment, but there is a decent amount of private investment also happening if you look at a broader array of companies' capex data. The little bit of a challenge is on the consumption side, where consumption growth is turning out to be weaker than investment growth. But still, the growth momentum at this point of time is quite strong. And that's partly because the feared global slowdown is not happening. We were all factoring in some headwinds to Indian economy coming from a global recession, if not a US recession, but all those things are now pushed back. That's why we think that to get around that 7.5% kind of GDP growth, even for next year, would not be too difficult for India. Now, if we take the right sort of approaches, then maybe we can push this growth even farther a couple of years down the line when the whole manufacturing story, if it fits nicely into this overall growth matrix.
One final point, and I'm reminded of October and also the fact that the bond index inclusion and how that will impact capital flows. Do you think there would be any concern or discussion, extended discussion within the MPC members on a rate cut and what will happen to the rupee's trajectory?
Well, RBI is probably now best placed among all the EM central banks on managing the currency volatility. Their war chest on FX reserves is massive. So it boils down to what RBI actually wants in terms of the currency's range. Over last 1.5, 2 years almost, the RBI is showing that it wants to keep volatility under check on both sides. But India has a very unique position where the bias is towards currency appreciation rather than currency depreciation because we are running a large balance of payment surplus, right? So that way, RBI's job is relatively easier. But given the huge reserves that RBI holds, even if for some reason the depreciation pressures emerge, it will be relatively easy for RBI to keep it under check. And from that context, the interest rate policy can be done very independent of the FX policy without being bothered about the risk of rupee depreciation.
That's an important point. One final bit, Samiran, and this is a bit off track, but a lot of colleagues in the newsroom have been trying to process the news about the RBI bringing back gold reserves. As RBI mandarins told me that it was not a one-off, more gold reserves would be brought back to India. I wonder what could be at play there, and what's your sense as to what the RBI is trying to achieve by the first phase of 100 tons and perhaps much more every year?
So it's a slightly complicated issue that the gold reserves that we have in physical form, it serves many purposes on certain kinds of transactions like swapping them or trading them. It's easier if you hold it abroad than if you hold it domestically. But the cost of holding it is higher abroad compared to the cost of holding it domestically. So that's the trade-off that you have. So depending upon how that trade-off is evolving, you might decide to put more abroad versus domestically. I think on the margin, a third factor has got added, which is that central bankers have become slightly wary about what happened after the Russia-Ukraine war, where assets of central banks were also freezed. So whether that can happen in a disaster scenario, and to prepare for that, to have more reserves onshore would be also a driving factor that has led to this sort of a decision by RBI.
Thanks for that insight, Samiran, because when we went into this news, it's clear, and I say this once again to you viewers on the basis of sources within the establishment, that much of the gold is likely to be brought back. Now, these are decisions as and when they are taken. We cannot sort of predict the numbers, but what Samiran Chakraborty just told us, the broader rationale, the third factor behind doing this is also very, very significant from a broader economic and political point of view. Samiran Chakraborty, thank you very much for your time with us today and for giving us a glimpse into how the RBI and the latest monetary policy, which by all accounts is going to be wait and watch. Thank you very much for your time. We'll be back with more viewers. Do stay tuned in. We'll slip into a very short break.
Good afternoon, ladies and gentlemen. Welcome to Market Masters, our special show on business today, where you get to meet